All right, thanks, Morgan. Hey, can everyone hear me okay? Just make sure that my sound's turned up to the correct level. Okay, fabulous. Let's go ahead and get rolling. So we have 25 minutes, and we're going to cover how to generate a weekly paycheck from the market, no matter the size of your account, even if you're a novice trader and you don't want to be glued to your computer. So if you're like me, I've been in this trading space for quite a while, and the concept of market, even with a small account, even if you're a novice trader, has got to be interesting. So let's go ahead and cover exactly how we do this. We're going to be talking a lot about weekly options. So if you're not familiar with weekly options, make sure you take out a pen and paper. Even if you are familiar with weekly options and some of the things we're going to talk about, take out a pen and paper, because hopefully we'll cover some stuff that's new to you and give you some new insights and perspectives on the market. Okay, so in June 4th of 2010, everything changed for options, and I firmly believe that June 4th, 2010 is going to go in the history books as one of the most important days in options trading, simply because that's the day that the CBOE, the Chicago Board of Exchange, released weekly options on the SPY, the Qs, the DIA, and IWM. And those are four of the highest volume ETFs on the planet. Now, ETFs, obviously, for most of you on this call are familiar with this, but ETFs have taken over for mutual funds, really, in the last few years. And there's over $1 trillion now invested in ETFs. And there's an ETF for just about anything. There's well over 1,000 ETFs. I think the last time I checked, there was 900 plus, and it goes up every month. But the big four, in terms of volume, have always been the SPY, the Qs, the DIA, and IWM. So the simple fact that now there is weekly options available on those has had a huge impact on the weekly options market. So let's talk a little bit about weekly options and what they are. They quite simply are really, really short-term options. They start selling on a Thursday. So for example, for next week, they're going to start selling for the week after this. And they expire 8 days later on the following Friday. That's for ETF options. For index options, they actually close on that same day on Friday, but the last day of trading is Thursday. And they're available in every single month of the year, except for on the third week of the month, quite simply because on the third week of the month, we can just use the normal monthly option and buy it on Friday, and it'll perform exactly the same and have the same prices as a weekly option would have. So they're not duplicating any effort there. So weekly options are quite simply a way to take your option trading from having an expiration Friday every month to having an expiration Friday every single week. So, and they're going to be noted by most brokers as, for example, as I show here, December 2, 2012, that expire on the second Friday of December 2012, and usually for most brokers it'll often say weeklies as well in the option chain. If you're not familiar with options and this is all new to you, that's totally fine. Weekly options have a lot of the same characteristics and almost identical characteristics to the monthly options. The only difference is they're only available for those 8 days, and they only trade from that Thursday until the following Friday. But they have some huge advantages. So let's take a look at the volume in weekly options and what's happened with weekly options over the past couple of years. So weekly options are nothing new. They go all the way back to November 2005 or even earlier than that, I think. I think this is just when they started tracking the volume. But if you notice, the volume was almost nil up until June. Right here, this bar right here is June 2010. And that's when they released them on the DIA and all the others that we talked about. And volume went through the roof. Until now, we can see that over 18% of all options volume, monthly or otherwise, is now on weekly options. So that is a huge, huge shift in the market in just 2 years. And like whether we're talking about this is going to have a huge impact on how we make money with options. So what's available on weekly options? If you want an up-to-the-minute list, because this changes quite frequently, you can just go to the CBOE site, just go to cboe.com, and the exact URL is there on the screen. But if you go to CBOE and look for the weeklies, they'll give you a spreadsheet that gives you exactly which options are available on which ETFs, indexes, and stocks. Now, it's going to include all the big cap stocks like Google, Ford, Apple, Netflix, but not necessarily every single week, because the CBOE releases options on those stocks timed around key events like earnings reports. But they're available on a weekly basis on all the major ETFs that you know and love, like the RUT, the DIA, the EEM, the GLD, the SLV, the SPY, and this is just a partial listing of the list. I think this is about 1/3 or 1/2 of the total list that's available weekly. So let's kind of compare and contrast weekly options with their monthly or their regular options counterparts. Now this case study comes from Schaefer Research, and it just is very instructive to show us the differences between weekly options and monthly options. Quite simply, let's go back in time to July 19th, 2010, and pretend that we want to buy place a short-term bet on Apple before its July 20th earning report, and we think that Apple is going to rise. And so if it's July 19th, 2010, we could go ahead, instead of trading the monthly option, we could buy a weekly option that expires on July 23rd. The reason we do that is quite simply, if we bought the monthly option, it would be much more costly, and we would be buying, we already know that we're only going to hold it for this earning period time, right? Only a few days. If we bought this monthly option, we're kind of forced to buy all this time premium and value through the end, through expiration in August, which would be the third Friday in August. By buying the July 4 240 calls, we can trim our baggage and give us exactly what we need, since we know the earnings report's coming out and we're going to be selling it after that. So if we were to buy on July 19th and to sell on July 23rd, 4 days later, here is a chart showing exactly what the price value of happened with these options. So you can see if we would have bought the monthly option, it was 21 and change. The value went down on the 19th and then came back up, and by the time we sold on 23rd, it was a profitable trade. Here's what the weekly trade looked like. We would have bought around 16. It trades down and comes back up as well. If we would have bought the Apple shares directly, we would have profited 5.9%. And a lot of people would be happy with that. A lot of people trade the Apple stock just by buying the stock itself. But as options traders, we know that we can get a little bit more leverage and a lot more return by trading the options in small measured quantities. We're not talking going whole hog and investing our entire account in one option or anything crazy like that. But if we bought a couple contracts on the monthlies, we could have bought 43.8%. We could have generated 43.8% return on that money invested. But by investing in the weeklies, we could have turbocharged that and got to 91.1%. But of course, isn't it all roses? When the market trades against us, weeklies are going to lose money faster than the monthly or the underlying stock, of course. So if we put this on a percentage timeline, and the black line represents 0% gain or loss, and the yellow line represents Apple, right? You can see that Apple price dipped and went up a little bit. What happened to the monthly? Well, the monthly is here in red. It went down and dipped. At the maximum loss point, if we would have got out in the trade at exactly the wrong point, we could have lost 2.3% on Apple. We would have lost 24% on the monthly, but we would have lost 34% on the weekly. So just keep that in mind. Weeklies do have a higher volatility than monthly, for better and for worse. So here's 5 downsides of weeklies that we need to talk about. They do have a higher gamma or price risk. There are fewer adjustments available in that there's not as many strikes available, so there's not going to be as many adjustments. You can't roll from one set of strikes to another or things like that. In the past, you would have problems with liquidity or execution. Now that the option volume is rising, options mostly on highly traded ETFs that like we do, the DIA, the SPYs, the RUT, things like that, not going to be as much of an issue. Commissions can be an issue, especially if you're not getting super discounted rates. I highly recommend that you use a broker like Thinkorswim, which is my broker. We get straight out of the gate, we get flat option pricing of $1.50 per contract, no minimum, and no ticket fee. You got to get at least prices like that to be able to make this work. The reason why, because with an options contract, if you're entering and exiting the trade, well, you're going to pay 2 sets of commissions. With weeklies, we're trying to set up trades where we just enter the trade and do not have to exit, and thereby we do not have to pay that exit commission. Okay. And number 5 is leaving risk on the table and not closing out positions. We need to make sure that we monitor these. We're not going to go on a trip to Hawaii or something like that and not monitor our Friday position, right? We're going to make sure that even if the trade is extremely profitable, if it looks fine going Monday, Tuesday, Wednesday, Thursday, we still have to monitor it and make sure that nothing bad happens. We don't want to leave that risk on the table. Okay, so quite simply, why should you listen to me? I've kind of given you a brief overview of weekly options. If you have any weekly options questions, you can go ahead and type those in the questions box. I probably won't have time to answer them today. We are down to 15 minutes, but we do have a little bit more time than we had earlier. But quite simply, very quickly, why you should listen to me is, quite frankly, I'm from a small dairy farming town, Preston, Idaho. If you ever saw the 2004 movie Napoleon Dynamite, that's the town that I grew up in, folks. I wasn't born with a silver spoon in my mouth. In fact, my cousin is a credited extra in the movie Napoleon Dynamite. So I really come from, middle America, small town America, rural America. But while I was in college, we did get lucky, and I got in on this little thing called the internet. Some of you have probably heard of it by now. But back in 1998, I sold an internet startup called iCentral to a company called Open Market for $11 million. Now, I didn't get all of that money or anything crazy like that. I was the VP of sales, so I got a small percentage of that. But that really helped me kickstart my career, and it led me to being involved with all kinds of millionaires, high net worth individuals. You can see there's a Gulfstream 3 Learjet that one of my consulting clients owns. There's me on the jet. In fact, I used to live in Beverly Hills, 9250 Robin Drive in Beverly Hills, right up the street from people like Larry Flynn and stuff like that. So I don't tell you this to impress you, but just to impress upon you that the kind of stuff that I teach, I'm a real world person. I don't deal with fluff or hype or things like that. But, I have traveled around the world working with multimillionaires. If you're familiar with T. Harv Eker up in Canada, he's kind of one of the most widely known financial and success speakers. He has a New York Times bestselling book, The Millionaire Mind, spoken at his seminars and done all kinds of stuff with individuals like that all over the world. So I'm no newbie. I'm no amateur. I'm not some guy sitting in my basement. When I do something, I do it right. I do it big. And I've always wanted to figure out a way to make money with these weekly options ever since we saw that huge volume spike in weekly trades going back to 2010. And it's not that I'm just an investor. I've done all kinds of entrepreneurial endeavors, so I have a kind of a wide variety of experiences. I'm not your prototypical. I'm not going to sit in front of my computer 20 hours a day and crank through trades. I'm not a day trader. I'm looking for trades that enable me to run my other businesses, but also have a good return on my investment, much like many of you. So, but most importantly, it comes down to my family. This is my family, my wife and my 3 kids. I don't do any of this to toot my own horn or anything like that. But hey, I'm just a regular guy. I'm a family guy. I work this. This is a business for me. I don't I don't do this to make $1 million bucks, but I do it to help share with people the things that I found that worked, the profitable things that I've blown through $100,000 investing, education and trading and back testing things and creating systems and all that kind of stuff. And I just want to share some of that with you guys. But if you're like me, virtually every time that I hand my money over to someone else, if I put in a brokerage account or my 401k or things like that, my returns go south. And so very early on, I quickly figured out if I wanted my money to make money, I've got to be the one to figure it out how to do it, how to create the systems to do that. And so that's what we're going to talk about now. So over the past couple of years, I've been searching and researching and documenting and testing, trying to figure out a way to make weekly options work for the average guy. And so the weekly option system that I've been searching for would need to use a trading vehicle that's simple and can be accomplished in less than 15 minutes a week. I'm sure for most people that's reasonable. It also needs to trade optimal, high probability trades. I want trades that have a good chance of making money. I don't want to make dozens and dozens of trades only to have 50% of them profitable, 50% losers. I want high probability trades. It also needs to be rules-based and non-subjective. And really, folks, I can't emphasize this enough. When I create something, I want it to be rules-based, non-subjective, that I can turn, if I write it out in a PDF and give it to someone, they're going to come out with exactly the same trades that I do. That's critical to me. And it also needs to trade in trending markets. So quite simply, without a lot of fanfare, credit spreads plus weekly options are what I think could be the perfect trading system that meets all those criteria. Less than 15 minutes a week, not day trading, high probability trades. So let's go through that and show that a little bit. on how that works. So credit spreads plus weekly options. So we've covered exactly what weekly options are. Hopefully for most of you, you now know what weekly options are and how they differ than monthly options. But let's talk about credit spreads. A credit spread, quite simply, is when a high premium option is sold and a low premium option is bought on the same underlying ETF. It's also sometimes referred to as a vertical spread. Now there's two types, a debit and a credit. We're mostly going to talk about credit spreads. But the huge advantage of credit spreads is it takes full advantage of this big monster in the room, theta decay. So let's talk about theta decay. Theta decay can either be a big bully or your best friend. Excuse me. Theta, quite simply, is the overwhelming force that is inherent in every single options transaction. And if you're not profiting from theta decay, you're swimming upstream. You're trying to be that kid in middle school that's kind of trying to fight back against the bully. So how do you get theta decay or theta on your side? Quite simply, theta is time decay. You know, Black-Scholes, which was the original options pricing model, and every other option pricing model out there, has designated the Greek letter theta as the time value of the option. So every option price actually has two values, the intrinsic value and the extrinsic value. The intrinsic value, right, is the value according to the contract. That's, you know, if the DIA is at 100, if I buy a call contract at 90, well, intrinsically, according to the contract, the terms on the paper, right, it's worth at least $10 because by terms of the contract, the market says it's at 100 and the contract, you know, says I can buy it at 90. Well, the part that most people leave out is it also has the extrinsic, the time value, or what I've referred to as the fluff value. And the fluff value is where we're going to make all the money. Okay, so let's talk a little bit about that. More people have lost money trading options by running out of time than by any other factor. And if we plot this time value, fluff value, or extrinsic value on a curve, this is approximately what it would look like. If we bought an option that's 9 months out, all of its time value would still be intact. But if we just held that option, did nothing else, even regardless of what the market does almost, not exactly, but almost, if 6 months go by, the time value of that option is going to go down about 10%. If we let another 3 months go by, time value is going to go down another 30%, until that time value, as we get to expiration, goes all the way down to 0. Okay? So what we're doing in weekly options is we're just dealing with this part of the curve right here. And on this part of the curve right here is we're able to capture all that time value without a lot of hassle. We know that it's going to 0. The time value is going to go to 0. We want to profit and we want to be a little part of this curve. So here's what a credit spread would look like using puts that if we think that the market is bullish. Okay. So if the stock price is somewhere in this range and we think that it's either going to stay the same, it's going to go up, or it's going to come down a little bit, the stock price is in this range, we could put on this bullish trade and profit from it and keep all the credits, right? On the flip side, if we think the market is bearish, the market's somewhere, the price is somewhere in this range, and we think the price is either going to go down, stay the same, or even go up a little bit, we could profit from a bearish call spread. So you can see that when we trade these credit spreads, we know ahead of time exactly what our maximum profit could be, right? Represented by this line right here. Or if the stock price, in this case, goes up against us, we know what our maximum loss could be. Those are all known and calculated ahead of time, so there's no doubt, there's no there's no vagueness, and there's no worry about exactly what it could be. So here's a simple example of a credit spread and how you'd put one on. So let's say that it's January and XYZ stock is at 54 and it looks bullish. You're confident the stock won't go below 50. So you could trade what's called a bull put spread using the February options. So you would buy a February 45 put, say that it costs about a quarter, 25 cents. That's your insurance. That's, you know, to make sure that you don't suffer a catastrophic loss. But then you would also sell a 50 put for $1 and collect that dollar. So what's the difference between the $1 and the 25 cents? Well, 75 cents. So in this case, your maximum profit would be $75 per contract. Your maximum loss would be the difference between the strikes. In this case, $5 times 100 minus the credit you received would be $425. So the maximum profit going to the trade would be $75. The maximum loss could be $425 if you let it slip that far. If the trade ends in your favor, you're going to make an ROI of $75 divided by 420, an ROI of 17.5%. Okay, that's just a simple example of how credit spreads work in general. So credit spreads on weeklies are very appealing. The reason is the concept of a credit spread in general is to sell an option, let the time decay bring its value down. You know, we're selling high and buying low. The bought option is used as protection to limit the loss in case we're wrong on a directional decision. And we can use those pricing rules to our advantage, taking into account volatility and time decay, so we can profit in the least amount of time. But here's the $1 million takeaway for today. And I'm sure all the other traders will agree with us. Quite simply, the time value of weekly options decays very rapidly in their short 8-day lifespan. We can often take advantage of this rapid drop in the options price due to time decay, which often overrides even the index or ETF turning against us. So this is critical that you write this down. Sometimes even when we get the direction of the trade wrong, because the time decay on the weekly options is so high, we can still make money and the trade doesn't end up going negative. This is a huge takeaway. This happens to some extent on monthlies as well, but on weeklies, it's just set up this way so that that's the way that it works. It's unbelievable how profitable this can be. So here's a typical spread using weeklies. Let's say that we're going to enter on August 3rd, 2012, and we would sell the RUT August 2, so the weekly on the 810 call. We would buy the 815 call. We'd receive a credit of 33 cents or $33 in credit for every $467 we placed on margin. When August 10th, 2010 rolled around, both of those options expired worthless. No closing trade was needed. So we get to keep that $33 in credit for every $467 we place on margin, or 7% ROI in a week. Here's what that trade looked like. So we were on a bearish trade. We entered on this candle. At the end of these candles, these are daily trades, right? These are daily candles, excuse me. So at the end of this candle, we placed a bearish trade. We set we set up right here and said, we don't think that the market will go higher than 810. The market did continue to trade up that way, but by Friday, it expired well below our 810 price, and we kept all the credits. So of course, the $64,000 question is, how do you determine where to place those strikes, right? So let's talk about that a little bit. Have you learned some insights today into weeklies and credit spreads? I hope you've learned a ton about weeklies. I know we have a short period of time, and we're actually coming to the end of our time, but I hope you learned a ton about weeklies and about credit spreads today, and this got your mind thinking about how you could use this in your trading. Now, for those of you who are interested in learning exactly how I do it personally and how I'm placing these trades and what strikes, I have an opportunity for you. Quite simply, I have a method that in back testing and some live testing, we're not going to offer audited third-party accounts or anything like that. This is brand new. This is the first day that we're offering this. But going back to 2010 and with a couple months of live trading, we've generated 71 winning trades, 2 small losses, and 1 large loss. So that's a win rate that's well over 90% using these credit spreads. Okay, 71 winning trades, 2 small losses, 1 large loss. Here's exactly what the system entails. The system identifies and spoon feeds you optimal high probability trade setups. It trades in only 2 days a week, a few minutes in each day. There's built-in money management. It's easy to execute. Trades in trending and sideways markets. No software, charts, or anything else to buy. And it is simple. It is simple, simple, simple. This isn't rocket science. I'm not going to send you, 27 DVDs that you have to go through, and by the end, you can finally figure out how to do it. This is simple. What you're going to get is proven, time-tested rules. Eliminate your guesswork. It trades, like we said, maximum Thursday and Friday. If a trade is signaled, a credit spread position is open that will expire the following Friday. We'll tell you exactly what the trigger is. The trigger is very simple. It happens most weeks. It doesn't happen every week, but when this trigger happens, you put the trade on and let it ride. These trades typically net in the 4 to 5% per week range. It's 100% rules-based, no confusion or subjective trades. If I put on a trade, you're going to get exactly the same trade. If you follow the rules to the letter, you're going to get exactly the same trades that I do. And I repeat again, it is simple. So the offer quite simply is, I'm going to give you the complete system rules. That's worth $197. I'm going to give you a complete spreadsheet of all the trades going back to 2010, the historical back test. And I'm going to give you automatic updates by email and text. So Even after you learn the system, you're going to get confirmation that you're doing the right thing, because I'm going to send you an automatic email and text message that says trade for the day is, and lines it out. You're going to get that automatically to confirm that you're on the right track. You're going to get our monthly Q&A and successes webinar. That's worth $297. You're going to get unlimited access to the private members area, where we have the videos that explain things more in depth, and all the trade examples and the trade histories. And you're going to get unlimited support and consultation. So quite simply, we're going to give you everything you need to get started using weeklies and these credit spreads. Okay, I'm trying to get the slides to advance here, Morgan. It like happened to us earlier. I can't get it to go to the next slide, so I'm waiting for a second for it to advance, and I'm about done. Okay, here we are. So again, here's what you get. You can get the complete system rules. Like we said, this is rule-based trading in an easy-to-understand PDF. It's about 7 pages. Covers everything you need to know about how to trade the system. That's a real-world value of $197. You get the complete spreadsheet of all the trades back to March 2011. You can look through the data and see exactly how it performed week in and week out. That's worth $197. You get the automatic weekly updates by email and text. That's worth a fortune, because it confirms that you're on the right track. You get the monthly Q&A and successes webinar, where we talk about questions and answers, but then also talk about people's successes. That's worth $297. You get access to the members area. That's worth $197. You get unlimited support and consultation through our support ticket site. That's worth $97. And let's talk about guarantees. I don't know you. I can't sit next to your computer and force you to make the trades. I cannot guarantee that you'll make money. Anybody that says you can guarantee that you'll make money, that's impossible. Second thing, we're not a library. We're not a lending library. You don't get a library card and come in, check out books, and access all information for free and then return it. If you're the type of person that buys every trading course and system under the sun, lets it sit on the shelf for 2 weeks, doesn't even open it, and then returns it under a 30-day money-back guarantee, this is not for you. Do not buy it, please. That said, we do have an ironclad 2-part guarantee. Part 1, and I took this from Dave Ramsey. I love this guarantee. If you do the trades, it works. If you don't do the trades, it won't work. If you work the system, you won't want your money back. If you don't work the system, you don't get your money back. Okay? So basically, hey, don't buy it if you're not going to do it. Part 2, though, just to cover those people who are thinking, well, does it actually work? Part 2 is part of that. We guarantee that it'll work. You make at least 3 times your investment back. So go through the entire training, trade live for at least 12 weeks. That's all I ask. I don't even put any minimums, the amount that you have to trade. You don't have to trade $5,000 or $10,000. Trade 1 contract if you like, for in the $400 to $500 range. And if you don't profit at least 3 times the $497 you paid in trading profits, you do qualify. You can get a complete refund, no questions asked. That's how sure I am of the probability of the system. We can't predict the future. I can't predict that you make money, but I do guarantee that if you don't make at least 3 times your investment trading it for 12 weeks, I'll give you your money back. Okay, real world value of $1,182. Today, for this TradingPub, this is the first time this is launched. We don't even have the website up. The PDFs are being created right now. You're on the ground floor on this. This is the first time that we've sold it. Your risk-free investment would be only $497. So to claim your copy, all you need to do, because this is brand new, like we just mentioned, we don't even have it on the website. So you'll need to call our secure encrypted voicemail at 509-720-7867. I want you to call that number now if you want to order. Leave a detailed message with your full name and address, phone, email, credit card number, along with the total amount, which would be $497. We'll return your call tomorrow morning, confirm and process your order, and answer any remaining questions and get you started on the training. Okay. I want you to take action now. This is the first time and the only time they'll most likely offer it at this value of $497. Here's another part, something that I can promise. Even using a small $2,500 account, this system will pay for itself in a matter of weeks. Do the calculations. $2,500 times about 4 or 5% a week. Being cautious, obviously, this can pay for itself in a matter of weeks. So again, to claim your copy, call our secure encrypted voicemail line 509-720-7867. Leave a detailed message along with your full name and address, phone, email, and credit card number. Hey, if you don't want to leave your credit card number on the encrypted voicemail, that's fine. Just leave your contact information. We'll accept that as well. We don't have our online ordering set up for this yet anyway, so it's not a big deal. Call 509-720-7867. We'll return your call tomorrow morning, confirm and process your order, and answer any remaining questions. Yeah, I about wrapped up. Morgan, thanks everyone for being on here. I've had a fabulous time with you. Thanks for everyone. We got a bunch of customers on here from some of my other products. Good to have you guys on here. For those of you who are new to my information, thanks for listening. Hope you learned a ton, and we'll turn the floor back over to Morgan.
All right, great. Thank you so very much for being on here, and we appreciate all of you guys for sticking with us, and we will get a copy of the recordings out. We're going to work with Chuck and get him to come on and do a copy of the recording as well. So thanks again for being here, and again, I'll post that number for you, and it's 7867, and then also I'll repost the link that Neil had mentioned as well, in case anybody's interested in doing that. So we'll try to get a copy of the recordings from each session up on our website, hopefully this afternoon, and then what we'll do is email it out to everybody, most likely tomorrow. But if you want to check back tonight, if you go to TradingPub.com and click on Free Education, so click on Free Education, you'll see it up there, and we appreciate you guys taking the time to be here. We definitely love to have you back, Kirt, and thanks again. I really appreciate you going twice there, and again, excellent job. I hope that you guys enjoyed learning about the trading the open with Neil, and then weekly options with Kirt, and then we're going to get Chuck's recording posted on our website as well. So we've got our next event in this room, in the TradingPub room, is actually going to be at 3:30 Central Time. I'll put a timer up there. You guys are welcome to stick around and join it. We'll kind of go quiet. I think we'll have a break here for, I guess it'll be about 2 hours and 10 minutes, but we'll go quiet until then, and you're welcome to just stick around, and we'll keep the room open for you. Thanks, everyone.